Well, good afternoon, everybody. For those of you that don't already know, I'm Joe Lucey, certified financial planner, CEO, president of Secured Retirement Financial. I want to thank you all for joining us on this week's Market Huddle. This week, we're going to be talking about 7 blind spots that can steal your retirement. You know, the last thing that we ever need when we're retired is to be all of a sudden blindsided by some kind of big financial surprise. Now, that could be underestimating how much we're going to pay in taxes. It could be an unknown medical expense. It could be a major downturn in the market early in retirement. It could be a loss of a source of income. There's a lot of different things that can go wrong, and nobody wants to get sucker punched by some huge expense, especially when you're at this stage of the game, when you're getting ready to retire. If you're within the red zone, if you're within 10 years of retirement or 10 years after you've retired, this is the most critical time to make sure that we have a secured retirement. So today we're going to be focusing on 7 blind spots, 7 things that you want to make sure that you're bringing into your retirement planning to make sure that you have a secured retirement. Now, whether you are an existing client of ours, or maybe somebody has forwarded this email to you, I want to make sure at the end of today's Market Huddle that everybody has an opportunity to schedule a short review with somebody here from the Secured Retirement team. So in a little bit at the end here, we'll make sure that everybody has an opportunity to do that. However, if you hear anything and you want to, if it's easier for you to make a phone call, you can always call us direct, 952-460-3260, 952-460-3260, and I'll post that number here in just a little bit as well. So anyways, hopefully everybody here sees my PowerPoint slide. Here's a slide that we share with you each and every week. The attorneys make us put this in there. It's basically some disclaimer language. Keep in mind that I'm not a CPA. I'm not a chartered a tax professional. I am not an attorney. If we get into anything that talks about law or estate planning, we don't draw documents like that here. Also, I know I'm going to be talking a little about Social Security. So I'm not a member of the federal government. I don't work for the Social Security Administration. However, we do believe in a comprehensive approach to retirement planning. It goes beyond just wealth accumulation. It's about how do we take our money back? How do we make it last a lifetime? How do we make sure that we can spend in confidence? Most clients are hiring us not because they're trying to turn a couple million into 5 or 6 million. They're hiring us because number one, they want to make sure that they can maintain their lifestyle, their income in retirement so that they can maintain that lifestyle. Number two, they would like to find ways that they can reduce their tax footprint, reducing taxes. And the third thing we do for families is help them grow their wealth, but never at the compromise of those first 2 areas. So if that sounds like you, let's make sure that we find some time to visit. Now, again, if you're an existing client, a lot of the times we have probably about 2/3 of those families that after these events are requesting visits are oftentimes folks that we have not visited with in the past, or maybe somebody that had visited with us some time ago and then they got an email, they were looking for a second opinion again. But if you are an existing client, feel free to make sure you schedule some time. Let's visit on some things. If there's anything that we talk about here today that's of interest to you, or you want to come back and see how that fits in with the planning we've done with you. So I want to make sure that you know that. And also at the end of this, we do make the presentation available to replay. If you have somebody that you think would benefit from it, feel free to forward it on. Whether or not you're a client of ours, we appreciate the passing on. So anyways, let's go through the 7 different things, these 7 blind spots that can damage the possibility of us having a secured retirement. Again, we know that life is going to have some surprises along the way. We want to make sure that we always are looking at those things that can go wrong, starting to plan accordingly, and know that we're in a position that we don't get blindsided, especially if something as simple as some of the things we're going to be talking about here today. So the first one, blind spot number 1, is to do with Social Security. Most of you probably already are aware that here at Secured Retirement Financial, Social Security optimization is a key part of what we do for families. In fact, I wrote a book, The Retiree's Guide to Social Security. I in the process of actually updating that, because we last did it prior to some of the changes in the Trump tax plan. But now with that said, we're going to see where taxes go. We're kind of trying to figure out, do we spend the energy to update that right now, or are we going to be going right back to where we were a couple of years ago, which means that the current version is still applicable, or is something new? So we're trying to figure that out. But keep in mind, not knowing when to claim your Social Security benefits can cost you hundreds of thousands of dollars throughout your retirement years. Now, according to Forbes magazine, 96% of Americans are losing on average over $111,000 of Social Security income that's rightfully theirs, and it's because they end up claiming their benefits at the wrong time. Forbes goes on to say that they believe that elderly poverty could actually be cut in half if all retirees claim their Social Security benefits at the right time financially. That's important to us because what we find here all too often is that we can go online. There's a lot of online calculators there, and there isn't an online calculator that's out there that won't tell you that if you want to try to optimize your Social Security, that you, and if you're married, a spouse, should both wait as long as you can. Wait till 70. I'm going to tell you that that thinking is generally wrong, just as wrong as somebody that says you should take it right away because you're not sure if it's always going to be there. The optimal way for you and your family to take Social Security is oftentimes somewhere in the middle. It's not 62, it's not 70, and it's rarely right at full retirement age, right between 66 and 67. A lot of times what we do is we show families how to optimize that, understanding that there's a lot that goes into the equation. There's cost of living adjustments. There's the cost or what our money's earning for us right now. There's also things to consider like taxation. Understand that up to 85% of our Social Security can be taxed. What that really means is that 15% in today's tax code is completely tax-free. In fact, if the only income you needed in retirement was Social Security, you would never file another tax return. That goes for anybody listening to us today. If you're married or if you're single, if the only income you needed in retirement was your Social Security, if you didn't need to take any withdrawals from IRAs, if you didn't need any other rental or pensions, there wouldn't be anybody listening to us because of the way that Social Security gets taxed that would ever file another return. So optimizing it is really the key here. It's not necessarily trying to maximize it. Maximizing it probably says you're probably going to wait till age 70, but because of longevity, because of the money that you don't collect early on, your break even gets pushed out so far that usually an optimal strategy is something different than just both waiting till 70 and again, both taking it right away or full retirement age. I want to make sure that if you have, if you're a current client of ours, let's review your Social Security strategy. But if you're not a client of ours and you want to see how to optimize your Social Security benefits, make sure at the end of the presentation you schedule some time. We want to make sure that we show you how to do this because Social Security, in my opinion, it's mailbox income. The more mailbox income we have, the more comfortable our retirement. Mailbox income is money that hits the checkbook each and every month, regardless of what's going on Wall Street. And about 90% of us have some access to the Social Security benefits. So we paid in every single paycheck from, in my case, it was a paper route when I was 12 years old. From the very first time we started collecting paychecks, we've been paying into Social Security. We want to wring every nickel out of it that we possibly can, make sure we're optimizing. So that's blind spot number one. We're talking this morning on the Market Huddle. 7 blind spots that can steal your retirement, making sure we look through all these. The first blind spot, let's make sure that we are optimizing our Social Security benefits and taking full advantage of that. Number 2, qualified account withdrawals. Now, you want to make sure that we understand how our qualified accounts, these are your IRAs, 401ks, 403bs, thrift savings plans, Minnesota deferred comp plans, any of these retirement accounts that were probably sponsored by your former employer or your current employer, or money that you set aside in a traditional IRA. This is money that you put aside, you didn't pay tax on it. It goes into this account, and then you agreed when you put the money in some time ago in your 30s or 40s or heck, even last year, that you'd pay tax somewhere down the road. So the blind spot here is really understanding that this money that's never been taxed can oftentimes trigger higher taxes when you start to take the money out. You don't want to think of all that money in your IRA or 401k as your money. A lot of times we think of our balance sheet and we start start putting down the entire balance, and which is, if you're working with a banker, you want to put down the entire balance of the 401k. But when you start thinking about your own retirement and the planning that you want to be doing around that, start to think of this account. Let's call it $1 million. You got $1 million in retirement accounts. Understand that $1 million, well, legally, when you're working with the banker, you put it on there as a part of the net worth. The reality is that that's not all yours. You have a silent partner on that, in this case, $1 million retirement account. That silent partner is the IRS. It's Uncle Sam, because none of this money has been taxed. Now, recognize here that I talk to a lot of families, and I have never met a family in my office in the last 25 years that didn't think taxes were probably going to go higher. In fact, I think there's more clarity today than we've had in 40 years that tax rates are probably at all-time lows. We want to start looking at how this money is going to be taxed, and we start looking at how we're going to take this out in the most tax efficient way. That comes with planning. You can't just wing this. It has to be something. Most families, if you miss the amount of money or you end up taking it wrong, it can create a situation where we start paying higher taxes in other areas. Maybe you're going to pay higher taxes on your dividends or capital gains. Maybe you're going to pay higher Medicare premiums. Medicare premiums can be oftentimes doubled, even tripled, because of distributions around our IRAs and 401ks. So we want to make sure we're looking at blind spot number 2. Understand how the money that comes out of your accounts is going to be taxed, understanding how that works for you, and let's put together a plan. Let's have a distribution strategy. Which of my money should I spend first in retirement? Should I be taking the Roth money, my savings account? Should I be taking it from the IRA? Should I spend some now? Maybe deferring blind spot number 1, Social Security, or do I take Social Security right now, knowing I might have to take more out of the retirement accounts? This all comes as part of the plan, what we call a tax smart plan, as you're getting ready for retirement, which brings me, as we start talking about taxes and tax smart planning, to our third blind spot. That third blind spot is understanding how required minimum distributions work. I cannot tell you how many families we have visited with that are absolutely surprised when they find out how much their required distributions are going to actually account to when they're forced to start taking this money out at 72. Understand that retirement accounts, IRAs, 401ks, 403bs, that's the only asset I can think of right now that the government will force you to start liquidating. There's nothing else. They won't force you. The government doesn't force you to take a capital gain. They don't tell you that you have to sell property. They don't tell you that you need to spend from your savings account or even the Roth IRA right now. But they do tell us that we have to start taking money out of our tax-deferred accounts at age 72. Now, this is a recent change from a couple years ago when it used to be 70 and a half due to the Secure Act. And knowing how these required distributions kick in for you is going to be absolutely critical, because if you get it wrong, first of all, there's a 50% penalty. It's the highest penalty that's ever levied by the IRS. That means that if you don't take out $10,000, if that's what your required distribution is, there's a $5,000 penalty. You're going to have to take out $10,000 and give $5,000 of it right back to the IRS, and then get taxed on the full 10 on top of it. So we want to make sure we understand that. Number 2, the biggest lie I think that we've been told as boomers throughout our retirement, getting ready for retirement, as we were accumulating this money, is that we would be taxed at a lower rate when we take it out than when we put it in. How many of us have been told that? You should start putting aside money from your work, take it out of the wages, put it aside into these IRAs. You're going to get a tax deduction. The good news is it's going to grow compounding, which has been a wonderful thing for so many of us. A lot of us have been looking at IRA balances far higher than we ever thought they would get to when we first started putting money aside. But what they didn't tell us, or what they told us, was that we'd take it out at a lower tax bracket. And what they ignored is that we're probably in many cases going to actually take taxes out at a higher bracket. A lot of us are going to have our homes free and clear, so we'd lose that interest and mortgage deduction. Property taxes right now are limited to $10,000. Many of you don't have that, but if you're paying the state of Minnesota, the state and local taxes plus property taxes limited to $10,000. So really, unless you're unhealthy and have a lot of medical expenses, or you're in a situation where you're doing a whole lot of charitable gifting, many families are no longer even itemizing. And what that means is that we're actually taking out money and we're paying higher taxes on the money than when we put it in. Now, the second rule of thumb, or the second I'll call it a lie that we were told, is once you put the money in the account, don't ever take it out. How many of us remember hearing that? Don't take it out. Don't borrow against it because the car breaks down. Don't take money out of this account because you wanted to take the family on a trip to Disneyland. Leave the money in there as long as you can. That's what we've all been told. So what happens at 62, 65, we retire, and then we remember this. Don't take this money out, and we leave it there cooking along, growing, compounding, doing its thing. All of a sudden, we get hit with a ton of bricks at 72. If you have $1 million account at age 72, the required distribution is just shy of $40,000. Now, that $40,000 is money that has to come out of the IRAs on top of Social Security, on top of pensions, rental income, dividends, interest, what else you have. Oftentimes, this is going to represent money that, number one, you would let continue to grow tax deferred. It never makes sense to pay tax on something you'd rather leave deferring. Number two, it can push you into higher brackets, higher capital gains, maybe higher Medicare premiums. It can double, even triple. Push you into higher brackets. Maybe you would have been in a 12 or a 15% bracket. It pushes you into the 22, or maybe you're in the higher bracket and it goes from 24 to 32. Keep in mind, you get in those higher brackets, you're oftentimes losing better than 40% of every dollar that comes out. We got to be protecting it. That is the third blind spot I want to make sure we're looking at. First blind spot, let's make sure we're optimizing Social Security. Number two, don't think of that money in your IRAs as all yours. You got a silent partner. The third one, we got to start planning about required distributions. The good news is you sit down with our team. We're going to make sure that we put a plan together for you, or we can review your current plan with a tax smart retirement program. That's what we're known for here at Secured Retirement. So the fourth risk, retiring in a down market. This is what we call sequence of returns risk. Think of it like this. If you are 35 versus a 65 or a 95-year-old, we know that that 35-year-old probably should be most aggressive with their money compared to the other two, the 65 or 95-year-old. Why? Well, they're working with smaller numbers. That's part of the reason. But the bigger reason is that they got more time. A 35-year-old that loses half their account balance at 35 has plenty of time to make it up. They're probably going to be working much longer. All that kind of works for them. In fact, when the markets come down, they actually dollar cost average. Are buying more stock while it's on sale, assuming it all recovers, which it will probably, historically, it always has. It could be actually an opportunity for the 35-year-old if there's a big downturn. Now we start asking ourselves who should take more, the 65 or 95. Now, when I was growing up, they used to tell us that, when you're 95, you want to make sure that you are really super safe with your money. Put it all in CDs. Keep it in the bank. Earn your 4 or 5%, 6% CDs and call it good enough. The reality is that if I'm comparing a 65-year-old and how much risk they should be taking to that 95-year-old, which we were always told should be super safe, I'm actually going to say that the 65-year-old probably has to be more cautious with their money, and it has to do with this retiring in a down market or the sequence of returns risk. A 65-year-old that were to lose half of their money today is going to change the rest of what their retirement looks like. The 95-year-old, because of things like mortality, longevity, it may not make that big a difference. So probably still have enough money so that they never run it out. So when you are 65 or in the golden decade between 60 and 70, you want to start thinking about being the more secure or safe with your money that you'll ever be. By the time you're 75 or 80, it's good to be actually increasing the amount of risk in that portfolio. You want to make sure you're working with an advisor that brings this into your planning, because a sequence of returns, a combination of the stock market lossing, you losing money in your accounts more than you should, and never being able to regain that, having to lock in losses, that can be devastating for retirees. We used to see this a whole lot more. When I first got in the industry back in 1994 now, we were far enough past 1987 and in 1997, which was kind of the first blip that really kind of came along there. Losing a lot of money real quickly wasn't necessarily on the radar when I first got started in 1994. It wasn't until 2000, 2001, 2002 when the market lost 50% that all of a sudden we started talking about sequence of returns risk again. And then back in 2007, 2008, when we lost another 50, remember that dead decade between 2000 and 2010 where the market actually broke even. It didn't make any money that decade. It's because of these two big corrections. And here we've gone since 2008, another 12 years without any major correction before last spring. Well, here we are Last year, a year ago today, you know, we saw the market down 37%. The bottom of the market was March 23rd. You believe that? We're up like 80% from where we were. Anyways, those families that were locking in losses in the spring got clobbered. Those families that could ride it out are doing okay, right? Because the market's had a tremendous comeback. The next month may not come back as fast, but you got to make sure you're looking at how much risk you're taking so you never, ever, ever have to lock in losses. Protect yourself for a sequence of returns risk. Our team can show you ways to do that. Let's move on to the fifth blind spot. The fifth blind spot has to do with low interest rates. I brought it up a few minutes ago. Remember, I talked about how the 95-year-old used to get 5-6% on their CDs. It wasn't that long ago. Now, 1-year CD is paying us less than 1%. I got to go out 5 years to get close to 1%. Interest rates are awfully low. Now, that can be an opportunity for somebody to look at taking out another mortgage, but for a retiree, it can be devastating. The safe money that we're working with, that money that used to earn us 4 or 5%, we're lucky to get 1 or 2%. In fact, there was an article in today's Wall Street Journal about corporate bond rates and how this used to be a safe haven and they're getting clobbered right now. Why? Well, we've seen the 10-year Treasury make a big move. You need to start looking at alternatives on how to get money with what are some bond alternatives. You need to make sure that you're looking at that. Make sure that if you're working with our team here, we talk about some of the other alternatives, the CDs. There's no perfect plan. There's a lot of different trade-offs. Make sure you understand everything about it. But keeping it all unnecessarily in the markets right now, as I was talking about earlier, might be a big mistake. Putting it into bonds. Warren Buffett just talked about this in his annual newsletter. He comes out with a newsletter that he sends off to all the shareholders every year. He said that if you're a pension, insurance company, or retiree, look out. Be careful of fixed income bonds right now because he thinks that with interest rates at all-time lows, you're probably teetering on a major problem. So we want to make sure we're bringing this into our planning as well. You know, retirement planning is not just about the wealth accumulation. I said that earlier too, right? It's about how do we bring that wealth accumulation? How do we tie it together with an income plan so we can spend in confidence? Money we're spending in our 60s, we don't wish we had back in our 70s. We have confidence knowing that it's going to last the rest of our lives. And God forbid something happens to Joe, Patty's going to be okay too. We're going to make sure that she's got a plan in place for those uncertainties that can happen. Number two, we want to make sure that we're reducing our taxes. I believe that reducing taxes, especially now where we have more clarity about the direction of taxes, the new administration is already proposing that they've got to do tax increases because of the almost $5 trillion that's been added to the national debt since this whole crisis began. They're now saying that they're going to have to raise taxes. So we know that with even more certainty. While I used to say I think we've got until 2026, I'm not so sure. I think we could see tax rates increasing as early as even next year. They technically, legally, they could still go up this year, but I think that there's a really good chance that 2022 we're going to see tax rate increases. If not 22, it's going to be. I think it's unlikely we're going to have until 2026. Anyways, I digress. Let's move on to the sixth blind spot. I see your question, Cliff. I'll answer that at just the end here. Rising healthcare costs. Understand that if you're retired, according to Fidelity, okay, healthcare costs, they've gone soaring due to COVID. They're higher now than they have been. More inflation in healthcare this year than we've seen the average returns. And Fidelity is telling us that a 65-year-old married couple should expect to spend almost $300,000 in healthcare and medical expenses throughout retirement. And that's if they do not have a long-term care event. So the average retired couple, 65, when you're looking at how much money you should set aside for health care, we're talking $295,000. If you're a statistic and you end up needing some long-term care, which 65-year-old today, there's a 75% probability you'll need some kind of long-term care either for you or your spouse, and the cost for long-term care is soaring. You want to start bringing this into the plan. Now, there's other alternatives than just traditional long-term care. Some families, yeah, you should be looking at self-funding, but maybe there's other ways that you can do that to kind of even make that a little bit more secure. So anyways, when we visit with you, if you're looking for a tax smart plan, if you're a current client of ours, let's talk about this blind spot number 6, the rising healthcare costs, making sure we are addressing this in your planning. I'm going to kind of start to wrap up here. The last one here that I wanted to talk about, this 6th one, oops, is going to be around inflation. I'm going to talk about inflation. I lost a slide here somehow, but quick recap here. 7 blind spots. The first one, make sure we're optimizing Social Security. Number 2, know how much of your IRAs and 401ks are going to go to taxes so you can make some real adjustments to your retirement planning. Those with a lot in retirement accounts, you're going to make sure that you're bringing that in so you're looking at things from an after-tax basis. The third one, know how required distributions are going to hit you here at age 72. Fourth, let's make sure we look and protect ourselves from market value adjustments. Having a big downturn, what they call sequence of returns risk, a big downturn in the stock market right as we retire. Fifth one, it's harder to generate income today because of low interest rates. Sixth, the average 65-year-old couple will spend $295,000 in healthcare costs, and they're going up faster than most other areas. The 7th blind spot I wanted to touch on was inflation. We're starting to see that with the 10-year Treasury jumping up. We were under 1% at the end of the year. We're now at 1.7. That's an indicator that the markets, the bond market, is starting to see a little inflation. You know, this is a situation where 1%, 2%, 3% inflation, it doesn't seem like a whole lot, but over the next 20 to 30 years, it really starts to add up quickly. So those things that were affordable early in retirement are something that becomes an unthinkable luxury. We want to make sure we're addressing this. That's why Ronald Reagan called inflation the silent killer. It's going to impact more retirees than almost anything else. Assuming that you have some longevity, you've got to bring that together into your planning, and that's what we can help you do. Reserve a tax smart retirement analysis today. Whether you're a client of ours or not, the phone number or an email is right there on the screen, 952-460-3260. I'm going to also offer here a second where you can get right on our calendars just by clicking right here. Again, that's open to those of you that are clients of ours. If you just want to review, go ahead and use that. Instead of calling in the office, it's easier for our staff to get you right on the calendar. We can find a time a little easier. Or if you are not a client and want to visit with somebody on the team here, let's get you a tax smart retirement program that are looking at all 7 of these blind spots. With that said, Cliff, you asked me about that Medicare form. And I think that the form you're talking about is the SSA 44 form. The SSA 44 form is an IRS form, a Social Security Administration form. So the SSA stands for Social Security Administration. And then if you just Google SSA-44, you'll see that there are 8 reasons that the Social Security Administration gives us where if we're going to get hit with higher premiums around our Medicare, these are based on what our income is. It has nothing to do with your net worth. How much income is hitting the 1040? In fact, most of the penalties around being retired have to do more with the taxable income versus what your actual true net worth is. We've seen multimillionaires pay a lot less tax than somebody that's worked hard and been in middle management up and, you know, retired from middle management. And really the reason why is because of the way that they can readjust their planning. It's what we want to make sure we can help you do. It's what a tax smart program is. In fact, most people don't realize it. Growing your savings today is more challenging than it ever has been. And the fastest and safest way that I know that we can help a family grow their nest egg is by actually reducing taxes. That's right. So by reducing taxes in your retirement, after all, the IRS doesn't care how much money you have on your net worth statement. All they care about is how the money hits the tax return. We're at 40-year lows, and we'd like to make sure we can help families do that. So if you want to get a tax smart retirement program, whether you're a client and want to review things or maybe just re-engage, or maybe you've never been in the office, go ahead and schedule from the meeting link that I put out there earlier. I'm going to give it another second. If anybody else has another question, go ahead and post it now. Otherwise, we'll conclude here. I don't see anything coming up. So if you're halfway through a question, go ahead and enter it, and then we can have you fill it in. That way I'll stick around. Otherwise, You know what? That's all we're going to have for this week. Thank you for joining us on this week's Market Huddle. I'm Joe Lucey. We talked about this week the 7 blind spots that can steal your retirement. We want to be a resource for you. And if you have questions on your current planning, feel free to reach out to us. And if you just want a second opinion, reach out to us. If not, when you get a replay on this, feel free to send this on to somebody you know that might be able to benefit from it. Jim, I'm going to answer your question here real quick. Is now a good time to enter the market? I think the stock market's going to be higher than it is right now, Jim, and that's barring any kind of unforeseen political or geographical type thing, right? So if all of a sudden they raise tax rates and they do it haphazardly, they don't do it with kind of a method, I think that the markets could really get hurt. But as interest rates are low, that's usually good for the market. There's a lot of money in the system with all the quantitative easing and all the stimulus. I think that's going to bode well for the market. But with that said, Jim, if you are currently sitting on the sidelines, you don't have any money in the market, maybe you had a cash out event of some kind, you sold some real estate, I don't know if I'd be putting it all in right now. Oftentimes what we'll do is we'll put together a structure for clients where we'll piece it in over a period of time. We'll put in a little bit over the next 12 months or over the next 6 months, try to tie what's called dollar cost averaging. Oftentimes the summer is kind of a little shaky. I wouldn't sell out right now if you're in the market, but I wouldn't be too surprised to see the market pull back as we get into June, July. This could be a summer that a lot more travel is going on, assuming that COVID kind of stays at bay. Which means that we might see a little bit more of a pullback than we've seen the last couple of years. I'm reading tea leaves, but Jim, if you had a life-changing event or you had a lot of cash sitting there, probably piece it in. If you're talking about just making a contribution of $7,000 into a Roth IRA for the year, I would have no problems putting it in because I do think the market's going to be higher a year from now. With that said, I hope everybody has a great rest of your week. Enjoy it as we get into spring here in Minnesota, and hopefully your NCAA brackets are all intact. And with that said, have a great rest of your week, and thanks for joining us today.